Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Monday, it is April the 18th. And what we're going to do right now is take a little bit of time just to explore some mid-cap potential energy buys. And of course, anytime I say these are potential buys or strong buys, I'm relying on the intelligence provided by some people who are much smarter than what I am, which could be a combination of analysts, some analyst reports that I've reviewed, maybe some media that I've seen where a number of analysts have changed their opinion or their rating from a hold to a buy or whatever the case might be. But anyway, for this little segment, it's going to be a look at 5 potential energy mid-cap strong buys. 5 of them, and maybe 3 of them are strong buys, according to smart people, smarter than me and you, potentially. Well, smarter than me anyway. I don't know about smarter than you. You guys are too smart. But let's take a look at what the experts say about some of these companies, and I'm sure a few of you are going to be familiar with them. So the first one up on the left here is Antero Resources, ticker symbol AR. Now I got a little backstory here for you, which almost to my shame and horror, I must admit that I opened a position in Antero Resources probably a couple of years ago, and my cost basis was $5 something. It was below $6 anyway. It got up to about $9 or so, and I plugged in a trailing stop, and I think at that point in time I plugged in a trailing stop of about 15% to protect my gain, which was like, for example, 50%, thinking, well, if it pulls back 15% and I cash out 35% as a gain, then I would have done all right. Only to check back in on Antero Resources today and see it's trading at $35.90. Or maybe that was the closing price on Friday. But anyway, hey, we all make mistakes and we're all human. And I just want to let you know that in case you've been guilty in the past of selling one stock too quickly, it happens to all of us, including yours truly, Mr. Roxy. So RRC is Range Resources Corporation. VET is an interesting company to me, Vermilion Energy. About 10, 12 years ago, Vermilion was actually a client of mine, but I have had no contact with them since, so it's nice to see them pop up again. Trading on the New York Stock Exchange is about $22. Murphy Oil is probably familiar to most of us, and many of you are following Centennial as well, because I see the ticker symbol CDEV sometimes in the comments and on my Twitter feed and so on. So these are the 5 companies that we're going to look at. They are basically trading in a range in terms of the stock price around 20, 30 bucks. Murphy, the most expensive, 42, and Centennial, inexpensive at $9.49. But is it inexpensive? Because we need to look at some of the ratios. So if we look at the 20-day stochastic, and of course this is for the technical guys, anytime the number is above 80, it is generally overbought. So in the same sequence as per the previous screen, I put the logos up here so that you can kind of keep track with who's who. Antero is at 100% range at 91. Vermilion is the odd one out here. So if you're a technical guy and you're following the stochastic as an indicator, the other 4 seem to be theoretically overbought, whilst Vermilion is not, or is the odd one out, the exception to the rule. From a weighted alpha point of view, you can see compared to their peers, they've all been the proverbial seeking alpha, right? Their weighted alpha scores are pretty good. And then today's opinion, by the way, I took the screenshot just before the market opened today on Monday, April the 18th. Today's opinion is 100% buy, 100% buy, 100% buy all the way through. Most recent earnings, pretty good for all of them, 46 cents, 96 cents, 95 cents, 40 cents, 39 cents, all positive earnings, good to see. And if we look at the price earnings ratio down here at the bottom, now, as a general rule, I've explained before, if it's below 15, I am usually interested in potentially taking a deeper dive. If it's above 15, that means it's sort of above the benchmark. Currently, the average PE for the energy sector is at around 17. So if it's below 17, you could arguably say, if I'm looking at PE as a benchmark or as an indicator to determine whether I want to potentially open a position into an equity or not, below 17, if it's an energy company, could be potentially good. Conversely, of course, if it's above 15 or 17 or so, then I might be a little bit more hesitant, but not necessarily. We just need to do a little bit of due diligence, make sure we do our homework. How have these stocks performed? So over the last 1-3 months, let's skip that and look at 6 months. If you bought any of these, or if you kind of have any of these long in your portfolio right now, you are probably very, very happy. In the past 6 months, so this is not even year to date, this goes back to October last year, 80%, 40%, 100%, 50%, 40%, really, really good gains over a very short period of just 6 months. So nice longs, and congrats to anyone who's long on any of these. By the way, I don't hold positions in any of these. And if I had to pick a winner right now in terms of a mid cap to potentially invest in, it might be one of these 5, but you can help educate us in the comments as well. Do take time to write us a note below and let us know what you think on any of these. Market cap, I said they're mid caps. Now, to be fair, Antero, because of the stock price, the market cap is already edging up to $11 billion. The others are more sort of in the proverbial mid cap space. If I can bookend it sort of between, or let's say mid cap, it depends on the sector as well, but I'd say mid cap from an energy point of view would be sort of between 2 and 10 billion in market cap. Annual sales, 4.6 billion, 3 billion, 1.6 billion, 2 billion, and 1 billion. Now, if we do a little bit of quick sort of price to sales, back of the envelope math on that one, 4 on 11 is about a third, 3 on 8, about the same. 1.6 out of 3.5 is about 50%. So Vermilion is currently delivering annual sales of around 1.6 million with a market cap of only 3.5, lending a little bit further credence to the fact that Vermilion might be inexpensive right now, or well priced to potentially open a position into. Murphy, 2 million out of 6, also around about a third, and Centennial, 1 billion on $2.6 billion market cap. So, sort of around almost half, 40% or so. So all of them are sort of in line, but Vermilion at a glance is generating approximately 50% of its market cap in terms of annual sales. How about income? Negative 400 range. It's pretty good if you just look at it at the $400 million number. However, when you're generating annual net income of $400 million on $3 billion of annual sales, your margins are actually quite slim. How about Vermilion? Once again, we see annual sales of 1.6. So $1.6 billion in annual sales and almost $1 billion in net income. As you could probably tell by now, Vermilion looks pretty good. Murphy, negative annual net income. Annual net income would also be a little bit deceptive because the prices have spiked most recently, and every quarter can probably change this number. And Centennial, similar to my comment about range, delivering $138 million net income of over $1 billion in annual sales. Margins are a little bit slim on that one as well. Look at this graph. Man, this is a pretty picture. So earlier on, I said if you had been in any of these 5 over the last 6 months or so, you are probably very happy. How about over the last year? Like, where do you get this kind of performance, right? The worst performer, the little green line over here, 127%, and the best one, almost 300%. Absolutely amazing stuff. Well done to all 5 of those companies, and well done to anyone who is long in any of those companies. Those are good equities to own, and they have been. Let's see what happens going forward. Pick number 1 by the analysts is Antero Resources. Natural gas liquids, and oil properties in the United States. It owns as assets approximately 502,000 net acres in the Appalachian Basin, a further 174,000 acres in the upper Devonian Shale. The company also owned and operated 494 miles of gas gathering pipelines in the Appalachian, 21 compressor stations. It has reserves of 17.7 trillion cubic feet of natural gas. Propane, isobutane, butane, gasoline, and 36 million barrels of oil. Some serious assets here by Antero Resources. Morgan Stanley sees decelerating natural gas demand in 2023 to 2024. So according to Morgan Stanley, we still have about a year or so to run on our current spike in liquid natural gas. Then they predict growth to slow a little bit. However, the recent uptick in political support could expand the demand on a 3 to 5 year horizon. What do the guys at TipRank say? Well, they have an analyst target price average of $38. They have a high price of 56, lowest price target 24. If it hits 38, it's almost 10% up from where it is right now. And they got 7 analysts rating this one, 6 say buy, 1 say hold. How about range? Let's take a look at this one quickly. The market cap, $8.6 billion. Independent natural gas liquids, and oil company in the United States. Exploration, development, and acquisition of natural gas and oil properties. It was founded in '76, an old company. As of December 31, 2021, Range operated and owned 1,350 net producing wells and approximately 794,000 net acres under lease located in the Appalachian region of northeastern United States. However, it missed the Q4 earnings estimates by a narrow margin. It guides effectively flat year over year on the back of a 14% increase in capex, modest dividend. But there's a surprise, an authorized buyback of almost 10% of the outstanding shares. What about range? Well, the target price for the analysts is $33. It's basically flat with where it is right now. They got 12 analysts covering it, 5 say buy, 6 say hold, 1 say sell. I don't have an opinion on range. If you're in range or if you know anything more about it, maybe you can share with us what you think. The highest price target is 44. Once again, the lowest price target is 23. How about Vermilion? Calgary-based, Canada. It's production of petroleum and natural gas in North America, Europe, and Australia. It's a nice diversified geography. As of December 31, the company had 401 net producing conventional natural gas wells, 2,132 net producing light and medium crude wells in Canada, 167 net producing light and medium crude wells in the United States. I'm not sure how you get 167.6 wells, but whatever. 297 net producing light and medium crude oil wells, and 3 net producing conventional natural gas wells in France, and 47 in the Netherlands. The Wall Street Journal reported that that the Biden administration is seeking ways to increase Canadian oil imports, but it does not want to resurrect the Keystone XL pipeline. Let's just pause there for a second. The Keystone pipeline has been in existence for a number of years and carries oil sort of in a let's call it like a geographical right angle. So imagine this. It's the wrong way around, so let's try this hand instead. From Alberta to Saskatchewan down to Texas or into the United States. The Keystone would have been a shortcut. You know, like if you think of that, Alberta to Saskatchewan to the United States, the Keystone would have been a shortcut. Not all the way, kind of like this. So the big political argument is basically about the Keystone XL, which is just a shortcut cutting across that sort of proverbial 90-degree tangent. It's just political football. It makes perfect sense to put that pipeline in place. Canada wants it, the oil producers want it, the consumers need it, but the political football continues. So don't confuse Keystone XL with the Keystone Pipeline. The Keystone Pipeline is an existing pipeline that carries a few 100 million barrels of oil and oil equivalent per day. Vermilion has a moderate buy rating. It has a $26 target price on average, which is 20% upside from where it is today. 4 people say buy, 5 people say hold, nobody says sell. The highest target is $42, giving you an average of 26 because the low is $19.80. How about the 2 that I skipped? So I gave a little bit of extra additional insight on Antero and Range and Vermilion, which means I kind of glossed over Murphy and Centennial. Murphy, the tip ranks analysts, so 8 guys covering Murphy on tip ranks, have a target price of $43, which is pretty much where it is today. There is a high price target of 58, but there's also a low at 31, so it's kind of in the middle, which is pretty much where it is today. So according to the smart people who are the analysts, if you're buying into Murphy, you should not expect too much upside from where it closed on Friday. How about Centennial? A little bit better, almost $11 target price, which is $16 above where it's trading today. 9 analysts are covering it, 4 are saying buy, 5 are saying hold. You got a high target price here at $13. That ain't too bad if it's trading at, you know, sort of 10 or thereabouts, or just under $10. Lowest price target $9. So currently it's sort of trading at about $9.50, $10, $9.50, $10 in that range. So if it gets to 13, that'd be nice. For people who are long on Centennial, best of success and good luck. So guys, that's kind of a quick wrap here. So 5 mid caps, and 3, according to the analysts, are strong buys. And those 3 strong buys are Antero Resources, Range, and Vermilion. Of course, if you like my content, I really would appreciate it if you subscribe, because it keeps me motivated to do some more. But more importantly, I would appreciate your comments down below. If you have positions in any of these and you have a compelling reason why any of us should possibly look at opening a position, please share. Let's give one another sort of a leg up and a bit of a hand in terms of creating some wealth for mutual benefit. To the guys who are long in any of these 5, congrats, man. That is such a good performance, and great picks by anyone who was long over the past year in any of these 5. By the way, if you have a great, beautiful gain on your portfolio, you might want to, take a little bit of profit, or plug in a stop to sell a little piece of it or something like that. It's great when stocks go up, and it's for sure it makes you feel good, but they don't always go up, right? So protect your gains or protect your investment capital, and if you can protect your investment capital, then you can let the stocks run and do whatever they will going forward with limited risk, right? Risk mitigation. Just make sure that you don't lose money. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Thanks to Mr. Buffett. So on that note, this is Mr. Oxy saying thanks for watching. I'll talk to you soon. Bye.